Welcome to The Explainer. Today we are diving into an investment theme that's driven by, well, one of the most powerful and predictable forces on Earth, time itself. We're talking about the longevity arbitrage.
This single idea really frames one of the biggest opportunities and, let's be honest, one of the biggest challenges we're going to face in the coming decades. It's this fundamental shift in our world, and as you know, wherever there's that kind of massive change, there's always opportunity for people who really understand what's going on.
Okay, so here's how we're going to break this down. First, we're going to look at the huge macro trend that's already happening. Then, we'll get specific and talk about where the real investment opportunities might be hiding, beyond the names everybody talks about. After that, we have to get real about the huge stomach-churning risks. And finally, we'll uncover where the real edge is for an investor trying to navigate this space.
Right. First up. And look, this isn't some wild guess or a hot take. This is a demographic certainty that is already baked into our future. It's happening.
Just look at these numbers. The scale of this shift is just mind-blowing. Back in 1900, only 4% of the population was over 65. It just wasn't a big factor. By 1980, it's up to 11%. But by 2030, just a few years away, 1 in 5 Americans will be over the age of 65. This is the baby boomer generation creating this massive, unstoppable demographic wave.
So this brings us to a simple but incredibly powerful formula. Here's what happens. You take a government policy that pays people at a certain age, think Social Security, think Medicare, and you combine that with a huge demographic wave of people moving directly towards that age. Well, suddenly the future becomes very, very predictable. The demand on these systems is for sure going to explode.
And a wave this big, well, it changes everything. The entire economy starts to shift. Retirees, they tend to spend less money overall, but what they spend it on changes completely. So less money on cars and commuting, way more on healthcare. This creates enormous pressure on our social safety nets and poses a huge challenge because people are living longer, but often with chronic health problems that need constant care.
So, if aging is the mega trend, the big question is, where do you invest? The obvious answers, the big names you always hear about, they might actually be the wrong ones if you're looking for some serious growth. In this slide, this lays out the core idea perfectly. You could bet on the giants, the Mercks, the Eli Lillys, but they're already worth $1 trillion. For them to grow 100 times from here, it's just not going to happen. The real opportunity might actually be in these smaller companies, the so-called puppies, that are laser-focused on solving one specific problem. They've got the potential to grow 10x, maybe even 20x, and still be a relatively small company. So instead of chasing all the hype around the latest weight loss drugs, the GLP-1s everyone is talking about, the really savvy investors are looking at the fundamental, kind of unglamorous problems of getting older. Take sarcopenia. It's basically age-related muscle wasting. It's a huge, huge issue for the elderly that affects their mobility, their quality of life, and it represents a massive, underserved market. It's often in these boring industries where you find the most exciting returns. And believe me, this is a huge but, investing in these puppies is absolutely not for the faint of heart. To even have a chance, you have to understand the brutal, brutal gauntlet they have to run just to survive.
You see, before any new drug can get to a pharmacy, it has to pass through years of these rigorous, incredibly expensive trials. Phase 1 is all about safety. Pretty simple question. Does this hurt people? Phase 2 is about efficacy. Okay, so it's safe, but does this thing actually work? And then Phase 3 is about confirming all of it on a much, much larger scale. And every single one of these steps is a point where the whole thing can just completely fail.
And Phase 2, that is what people in the industry call the Valley of Death. This is the stage where most drugs fail. They might be safe, sure, but they just don't do what they're supposed to do. And tragically, this is also the exact spot where most retail investment money goes to die.
The financial stakes here are absolutely colossal. A company can pour hundreds of millions of dollars into R&D only to have it all go up in smoke. A single negative announcement from the FDA can cause a stock to gap down, which means it literally opens for trading at half its value from the day before. It's a binary event. You either win or you lose. There's no prize for almost working. It's success or catastrophic failure.
And all of this leads us to the brutal, honest truth about this kind of investing. You have to be crystal clear about the kind of game you're choosing to play here. Yeah, this is not your grandfather's stock picking. The outcomes in early-stage biotech are almost always binary. It is a 10x home run that changes everything, or it's a complete wipeout. It goes to zero. There is almost nothing in between.
Now this right here is probably the most critical distinction that so many investors miss. Let's say your company, against all odds, makes it through the valley of death. They get FDA approval. That's a clinical success, right? But that does not guarantee a commercial success. Is the market for this drug actually big enough to be profitable? Can they beat their competitors? Can the management team actually sell and distribute it? A successful trial does not automatically mean a profitable drug.
You just have to approach this with the right mindset. You're not buying a stable, boring utility company. What you're really doing is acting like a venture capitalist. You're funding these high-risk scientific ventures where, yeah, the probability of failure for any single one is incredibly high. But the payoff, if you get just one winner, can be so massive that it covers all the losers and then some.
So, you're probably thinking, if the risks are this high and the outcomes are so black and white, how can an investor possibly succeed? I mean, is it even possible to get an edge in a game like this? So where does that advantage come from? Is it about trying to be a better scientist than the actual scientists? Is it about poring over medical journals trying to predict the outcome of a trial? No way. For most of us, that's a losing game. The real edge, the real arbitrage, is found somewhere else entirely. The real advantage comes from screening. It's about having a disciplined process, a checklist, to filter these opportunities before you even think about investing. It's asking simple but crucial questions. For instance, does the company have enough cash to get through its trials without needing to raise more money? Does the CEO have a track record of actually bringing a drug to market? Is the potential market for the drug in the billions of dollars, not the millions? Answering these lets you throw out the obvious losers, so you're only fishing in the right pond, so to speak. And that leaves us with this final and I think really crucial thought. In a world of 10x or zero gambles, a world that's just dominated by probability and luck, you cannot focus on the outcome. A great process can lead to a bad result. A terrible, uninformed gamble can get lucky and work out. The only thing you can truly control, the only place you have a real, sustainable edge, is in the quality of your decision-making process. And in the long run, that's what separates the winners from the losers.